Hi and welcome back to the third video on covered calls. And here we plan to talk about follow-up actions. We already understand the covered call basics. We should also have an idea on how to compare different covered call strategies based on expected return. We also know the differences between different covered call strategy types. Now let's see which follow-up actions are available to us. There are three main categories. Actions to do when the stock price drops, follow-ups when the stock rises, and protecting your position when the option loses its time value. What can we do if the stock dropped a lot? This depends on your goals. If you want just to limit your losses, it is okay just to close the whole position. Small drops are covered by the option premium, so you will not lose much. A better option would be to roll the option down. Rolling the option means that you are closing your current position and you are open the new one. In this case, you will close the current position for the profit because the stock dropped and your call is now cheaper to buy back. And then you will just sell a new one with a better price. So rolling down means that now you will select a lower strike, while rolling up means that you will go with a higher one. You can also select the next expiration date and to get more value, or you can also select a different strike. Since you will go with a lower strike, it will be closer to the actual stock price, so it will be more expensive and you will be able to collect more in option premium. And same for the expiration date. The more time you have until the expiration, the more income you generate from the option sale. Of course, you can roll to the next expiration date and to the lower strike at the same time, which will result even in the higher premium. But remember, it will increase the risk because the stock can bounce back. But if it will drop a bit more or if it will stay at the same level, you will have a higher level of protection. Now, what are we going to do if the stock rises? Many people say that this is a really nice problem to have, but I personally have the highest FOMO in this case. Everyone is happy, their stock just jumped 20% up and you are the only person who sees the profit in their account, but you know that you will have to give it back. You will have to give it back, all of it. And the only thing that will be left is just the small option premium. So what to do here? You can do nothing and just wait for the stock to be called away. Because in most cases, if you remember, this was the initial plan. And if the stock is just slightly over the strike price, then it is actually okay and it is indeed nice. But you can also roll your position again, meaning that you will have to buy back your current short option for loss. And it will be a loss for sure because the stock price comes closer or even over your strike. So you either already owe somebody some profit, or the chances that the stock will be in the money are way higher than they were before. But it will not be easy and it will not work in all of the cases. If the strike price was 50 and the shares are currently at 60, you will already have to lock in the loss of $10. So in order to stay profitable, you will need to sell a new option at a higher strike price. And to recover all of the losses, you will need to ensure that your option will expire worthless. In our example, if the strike is at 50 and the shares are currently at 60, you will have to buy back your options for at least $10. Of course, in total, it will be less because of the premium received in the very beginning. So if it was, let's say, $5, your total loss will be $5 because 10 minus 5 of the initial premium, it's $5 of the loss. Now, you found a good contract in the future with a 60 strike price selling at 7. So it is already lower than you had to pay for your previous option. Not really good, but higher strikes are even cheaper. So what happened after this roll up? Let's take a complete picture. You received a $5 credit, then you bought a losing option back for a $10 debit. You're at -5 right now. And then you sold a new contract with a high strike for $7. You have a $2 credit now and your stock will not be called away at 50. So basically you can enjoy your stock profits and that new $2 credit which you received from the option sale. Of course, it's lower now, but you have saved your stock profits. The interesting difference between rolling down when the stock drops and rolling up when the stock rises is that rolls down are made for credit, meaning that you will get more money from selling more options. On the other hand, rolling up is made for debit, so you will need to deposit more or lower your potential profit from the option premium. Many option traders consider rolling for debit a serious problem because you now have less profit, you now have more risks, and you are still locked in your position until the expiration. It is really, really uncomfortable, and most traders just do not roll for debit. I guess this should cover all the basics of the covered call writing. Overall, this is a neutral or slightly bullish strategy, and it is usually used when you expect a sideways action or just a little small increase in the stock price. But you can also use it if you want to protect your downside before a correction. However, there are some other better ways to do it. The upside risk of the strategy, well, it depends on how you see it. The main problem is that your option can get exercised and your shares will be sold at the strike price, so you will not be able to participate in a bull run with a covered call. The downside risk is unlimited. Since you are holding shares at least until expiration or until you decide to close the option, shares can go down. Well, technically it is not options' fault here, so if you are an investor, this strategy will generate some protection for you, but it will be rather small compared to how far the stock can fall. Let me know if I missed some interesting stuff here on covered calls. There is actually a lot more information to cover, such as locked-in losses, how to play with multiple contracts, and so on. But for beginners, this information should be enough. We will be adding more in the future videos. I hope that you learned something useful here and you already subscribed to the channel. If not, then please do so and also tap that like button because covered calls will just work better if they know that you like them. See you in the next video and thanks for watching.